Rebecca Walser, president of Walser Wealth Management. Such a pleasure to have you here as always. What geopolitical issues are markets most sensitive to right now?
Well, we've got a lot of positive things happening, right, Brad? We've got January 15th, the China 1 phase still going to be signed. USMCA is going to pass, hopefully the Senate Finance Committee, Banking Committee today, that will go to the full floor of the Senate for pass, and then obviously President Trump will sign it. So we've got a lot of positive things. With Iran specifically, obviously we're looking here for pressure on oil prices. The Middle East, although they're not no longer the first or second producer, you've got the United States and then you've got Russia. So they're not even, this is not a 1979 situation when they stormed the U.S. Embassy. This is a completely different situation. But yes, obviously an impact in the OPEC producing amounts would produce price pressure on oil.
What's more volatile right now, Rebecca, stocks or oil?
Well, I guess it depends what happens in the next 2 weeks, right? But I do think that obviously the oil prices are what we're going to be looking at. The Fed's going to be looking at oil prices because that's an inflation barometer. So obviously those are the kinds of things that we don't want to see an escalation. If we can get, past this whole situation that happened geopolitically, that I think the markets will kind of look more beyond that and starting to look at the fundamentals of 2020, which are still actually very, very good.
Is there a role that you think China plays within the U.S. and Iran turmoil that's taking place right now?
Yeah, they were really measured in their words to the United States. They were just, encouraging the United States to look at diplomatic ways to resolve it instead of forceful ways. And I thought that was very interesting, their choice of language. I'm a lawyer, so it felt like a lawyer was writing it.
Rebecca, when it comes to risks that still exist, it seems like the geopolitical concerns are not going to go away overnight. And so what do investors need to know, right, when putting their money to work in this market, perhaps at the new year and trying to hold it until the end of the year?
When you're an investor on the sideline, you don't like necessarily volatility. So we'd like to see stability. But there are some real positive things that are happening. Obviously, we talked about USMCA. We talked about phase one China. But also the UK and Brexit. That's going to be an upset to the EU. And we know that happening the end of this month. But it's also a window of opportunity that we're going to have with the UK to establish a bilateral trade agreement that's going to be one of the strongest in the entire world. So we have a lot of positive things that are going to be on the outlook for 2020. Obviously, starting off the very first day of the new year, the second day of the new year with, a strike that could potentially lead to an escalation is not positive. But I think investors, if we can get through these next 2 weeks and get some calm and some resolve, not escalation, I say that, but I would like to see it in the next 2 weeks, right? We would all like to get this resolved very quickly. We'll see what happens. But right now, investors should be aware that there are positives and there are negatives.
That said, are there areas of the market right now that you see are either overcrowded or overbought? And where should we be looking for those sectors and looking for some of those opportunities?
I think right now we aren't in an overbought situation. If you look at the earnings per share and the multiplier, we are historically not in terrible territory. So we still have some runway. And I think that 2020, the fundamentals, Brad, are still there. The lowest unemployment, some of the classes have the lowest unemployment on record ever. We've got real wage growth, and that real wage growth, unlike what you hear in the media constantly, that real wage growth is at the lower levels. Their wage growth is outpacing the middle and higher levels. So with the economy at this level, if we can get the geopolitical stuff more resolved, then I think that we have some opportunity. Now you're seeing that NASDAQ is still up when the Dow and the S&P are down. So that tells you that we're still seeing a lot of bullish tendencies in the tech stocks. And I do think the tech stocks, with a lot of things that are happening, have more room to run. And I think everything has more room to run. Although I will caution us, Brad, we are, 11 years into a bull market in March, which is unprecedented, as we know, and we should always be prepared for a rainy day.
So it's interesting, Rebecca, because these tech names, they still do defy expectations. It's incredible, even at very lofty valuations. When investors think about it, it's a new decade, right? Okay, so the lagging sectors of the previous decade, the 2010s, were sectors like energy and materials and even utilities, right? Are those sectors that investors should be reconsidering in the new year simply because of a reversion to the mean?
Well, of course, anytime, Kristen, we're having a recessionary potential track, which I'm not saying that's where we are, but I'm just saying when people are starting to get jumpy and thinking, oh my gosh, and just if you look at the length of this bull market, you could easily think that. You ever want to look for your safety vehicles, utilities, obviously one of them, and bonds clearly as well. So a reversion to the mean. I don't know if that's going to happen this 2020, but if we are looking at that, then investors are going to digress into positions that are considered safety positions that are going to be there whether the world is on fire or not, because we all need electricity and lights. So I do see that people will be making some safety plays, and I just want to caution people that it's just not going to happen just yet. I mean, as long as we don't have World War III breakout, I think the market is going to be stabilized.
What about business investment? Do you see that slowing or kind of reaching a stalemate as there are still these larger geopolitical concerns? Is that an instance where companies themselves will hold off on making big purchases or big investments that could help their business over an extended period of time because of that uncertainty?
Yeah, Brad. Well, there's really two factors on business investment that we really have to take into consideration. And so obviously the last 18 months with the escalation of a trade war that President Trump initiated, which we hadn't seen actually in a long time, business are actually going to be more stabilized with phase one China. Now, obviously we have to see if China is going to comply with and stay true, but there is an actual enforcement measure in the actual agreement. So I think we're going to actually see more stability on the geopolitical trade front with the phase one China getting signed, USMCA getting signed, and also UK having the ability to, once they're free of the EU, to actually work with us. The other thing that we have to look at, though, is what businesses did do when they actually lowered the corporate tax from 35 to 21, and we were able to repatriate some money starting in 2018. And we did see, although a lot of people said, oh, they just bought back stock, we actually did see quite an expansion of business investment in 2018, and it didn't look bad for 2019. So if you've got the last 2 years of high business investment because of the corporate tax changes, and you also have kind of the levelization of trade from a trade tariff perspective that we've had for the last 18 months, we could expect 2020 to have some positive numbers, kind of mixed bag of information on that side.
Quite a market. I mean, it does still defy all expectations. Rebecca Walser, she's the president of Walser Wealth Management. Thanks for joining us.
Thank you both.